Bismillahirrahmanirrahim. Assalamu alaikum. I am Sayyid Akif Shah, lecturer finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Financial Management, and the course code for this subject according to the new curriculum is BS 251. This is our lecture number 25. And the topic for today's discussion is required rate of return and cost of capital. The outline of this lecture comprises of the discussion related with the required rate of return and the cost of capital. That is to explain that in the context of a legal firm or a business entity, we will discuss what is a required rate of return while they are looking to invest the company's or the business precious money in the prospective proposal for investment, and how to generate finances for that investment opportunity, what should be its required rate of return while investing in that project or a proposal or an investment opportunity, and the finances are the resources or the sources from where you have generated the resources or financial need. You have to pay certain amount of money over those resources which you have borrowed is named as the cost of capital. We'll discuss the cost of debt instruments because we have basically three sources to generate finances for our prospective investment opportunities. These three main resources are the debt finances, that is to borrow the money from the creditors or the depository institutions, or another way around, the company can also issue its own corporate bonds for the same purpose. As a second option, company can issue its preferred stocks to generate or to accumulate the resources for the investment opportunity. And last but not the least, company can also issue the common stock which is named as equity to the prospective shareholders so that to generate capital for investment opportunities. So let me explain you that this cost of capital and required rate of return can more easily be elaborated in the context of the company form of business organization, because normally preferred shares and as well as the corporate bonds are not issued by the partnership type of business and as well as by the sole proprietorship. So therefore our emphasis will be on the sophisticated or the formalized legal form of business organization named as a corporation or a company form of business organization. So when a company is looking to invest its precious money in the prospective projects or proposals, then it has to look at the required rate of return of that investment opportunity. We'll have to compare it with the cost of capital. These three are the main resources: debt financing, preferred stock, and as well as common equity to generate capital required for the investment purposes. So on these three main sources of finances, the company has to pay certain cost which is named as cost of capital for borrowing these funds from different depository institutions, the prospective investors, and as well as the existing common shareholders and the future common shareholders. The main purpose of this lecture will be to discuss the cost of different sources of finances, that is cost of debt financing, how to measure it and what's the formula for calculating the cost of debt. Secondly, how to measure the cost of a preferred stock to the company. And finally, last but not the least, the cost of equity to the firm while they are looking to invest their money in the prospective proposals. So let's discuss one by one in detail. What is overall cost of capital of the firm? Definitely the blend of the three resources what we have discussed in the outline of this lecture comprises of different proportion of capital raised or financed by the company. So we have to find out the overall cost of those three resources to the firm. What's the cost of capital? It is the required rate of return on the various types of finances as discussed in the outline of this lecture. However, the overall cost, what is the overall cost of capital? The overall cost of capital is a weighted average of the individual required rate of returns. The definition says that we have to calculate the weight of the debt, the weight of or the proportion of preferred stock used by the company, and similarly the proportion of equity used by the company, and we have to multiply their weight with the amount financed by the company, and hence it will give us the total overall cost of capital to the firm. So this definition explains that the overall cost of capital for the firm is the weighted average of the individual required rates of return. This WACC, or weighted average cost of capital, will be discussed in my subsequent lecture. Here it's a glimpse of the proportion or overall cost of capital what we have discussed for instance before. We have basically three types of financing, and the market value of long-term financing is mentioned before you. We have the long-term debt in our company. We have preferred stock, and the last option, which is very important, is common stock equity. So our company, we have assumes these values, and this is a hypothetical example to explain the market value and different weights which could probably be used by the company in an organization. So in this case, the company's market value for the long-term debt, which can be a borrowed money from the bank for the period of time more than 1 year, or the company might have issued its own corporate bonds, which could be zero coupon bond and as well as could be a coupon paying bond, and their worth is $35 million. The company has generated $35 million from long-term debt instrument. Similarly, the company has used preferred stocks of 15 million. They have issued preferred stocks to the prospective investors, and the amount raised from this source is $15 million. Finally, the company has also utilized the third option of common stock equity. The company has generated $50 million from the common stock equity. In total, by utilizing or using the three resources, the company has generated $100 million from three main sources of finances. Now, how to calculate what portion or what weight the company is using for these different kinds of financial resources to utilize for fund generation. So you can simply divide 35 million with the total amount of capital raised, and it will give us 35% weightage of long-term debt in this capital structure of the company. Similarly, 15 can be divided with the total amount of capital of 100, and it will give us 15% weight. And finally, 50 divided by this total amount of capital raised will give us 50% weight to the common stock equity. So now we have seen that the company has used 35% long-term debt resource or source, and similarly 15% preferred stock source has been used to generate funds. And finally, the major reliance is on the common stock equity, which is 50% company has utilized the common stock to generate finances for the prospective investment opportunities. So here come, if we sum up all three weights, we will come up with 100%, which will tell us that we have utilized long-term debt, preferred stock, and common stock in 35%, 15%, and 50% respectively proportions to generate $100 million for our company. Let's discuss the first source of finances, that is known as the cost of debt, and how to calculate what is cost of debt and how to calculate the percentage or the cost of debt in the terms of percentage figures. The cost of debt is the required rate of return on an investment of the lenders of a company. So let's suppose the company has borrowed certain amount of dollars from a bank. The amount in terms of percentage the company is supposed to pay out to its lender is known as cost of debt instrument. How to calculate that? We have formula that is representing P naught is equal to summation j start from 1 to n I subscript j plus P subscript j the whole divided by 1 plus kd raised to the power j or n. Here j is the relevant instrument used by the company to generate funds under the debt instrument obligation or contractual agreement. P naught is our current market value of that instrument. Ij represents the annual amount of interest supposed to be paid out on that instrument. Pj is the maturity value of that instrument. Like for example, the company has used the bond instrument to generate debt financing. So Pj will be the maturity value of the bond or the face value what they are required to pay out in the future. The whole divided by 1 plus kd raised to the power j. Here kd will be the percentage we have to find out for our company, which is named as the cost of debt instrument. So dear student, know that this kd is referring to the before tax cost of debt instrument, but we are interested to find out the after tax cost of debt instrument, which is referred over here as k subscript I is equal to kd what we have calculated with the help of this formula into 1 minus the corporate tax level, because this interest is a tax deductible expense. So therefore the tax shield benefit what the company has realized should be subtracted from the total cost of debt instrument, so that to know that in order to come up with the exact amount of the cost of debt. This will further be explained with the help of a numerical case. So let's take an example of Basket Warner has $1,000 of par value, 0 coupon bonds outstanding. Company has issued 1,000 par value of 0 coupon bond. By 0 coupon bond, we mean that the company is not going to pay out any amount of interest on these bonds. The Basket Wonder are currently trading at $385.54. So the current market price of this bond is $385.54, and this bond is left with 10 years of maturity. The Basket Wander's tax bracket is also given, which is 40%. And the question or the case asks you to find out the cost of debt of this company, which is Basket Wander, under the scenario of zero coupon bond. So the formula to calculate is to equate the current price of the instrument, which is P naught. We have equated P naught, plugged the relevant data, which is our current market price. It is 385.54 is equal to the interest payment, as this bond is zero coupon. So therefore, the interest payment is $0 over here. The maturity value is usually the par value or the face value what the company is going to pay out at the completion of the contractual obligation at the end of 10th year. So therefore, this $1,000 is your PJ, or the maturity value, whole divided by 1 plus KD raised to the power 10, because n is 10 number of years later this instrument will get mature. The only missing value in this mathematical equation is KD, which is our prime interest to find out. Now the question is quite easier to find out this KD. We can simply multiply both sides with 1 plus KD raised to the power 10, and it will be cut off over here. Rather, it shall be mentioned at the left hand side with 1 plus KD raised to the power 10. In the next step, we can also divide both sides with $385.54. So therefore, this expression will go towards left hand side and the remaining equation will be at the right hand side. As we can see that we have cross multiplied with 1 plus KD raised to the power 10. 1000 divided by 385.54 by simply rearranging the equation with the help of cross multiplication and division at both sides of this equation. The resultant value come up with 2.5938. In order to remove this power from the left hand side, we have to multiply it with 1 over 10. So if we multiply 1 over 10 at both sides, so automatically this raised to the power 10 will be cut off from left hand side, and it will be mentioned at the right hand side as 1 over 10th power to the 2.5938. By using the simple mathematical calculations, we come up with 1.1, which is actually the, if we subtract 1 by putting this at the right hand side, 1.1 minus 1, we're left with KD is equal to 0.01, which is ultimately 10%. If we multiply this value with 100, so the before tax cost of debt under this case for the company is 10%. However, the corporate tax shield for this company is 40%, because this interest amount or the cost of debt is usually the tax deductible expense. So therefore, we have to calculate the after tax cost of debt. In order to find out the after tax cost of debt, we have to use the yellow box formula, which is Ki is equal to Kd into 1 minus tax rate. By plugging the relevant data into the formula, 10% into 1 minus 0.40, we come up with 6% after tax cost of debt for this instrument. So this is the way how you can calculate the cost of debt for a company. Let's come towards the second agenda of this lecture, which is cost of preferred stock. It's how to calculate its cost to the company. The cost of preferred stock is the required rate of return on an investment of preferred shareholders of the company. So let's suppose if the company is paying out certain amount of money as dividend to the preferred shareholders, and we would like to find out its cost in terms of percentage to the company, so we can use a simple formula as mentioned before. KP is referring towards the cost of preferred stock to the company. So we have to divide the preferred dividend in terms of dollar by the current price of the preferred share, which is P0. So let's do it with the help of a numerical case to explain and understand this mechanism in more detail. Let's assume that the Basket Wonder has preferred stock outstanding. What's the preferred stock? It's already been explained to you that they got priority over the dividend payment than the common shareholders, and usually it has a fixed percentage of dividend to be paid out to the holder of these preferred shares. So the Basket Wonder has preferred stock outstanding with a par value of $100. Its face value per share is $100. The dividend per share of $6.3 has been paid out on these preferred stock at the completion of first year, and a current market value of this preferred share is $70 per share in the market. So we got the relevant data. We have to plug this data into a formula, which was KP is equal to the preferred dividend, which was 6.3, divided by the current market price of this preferred share, which is $70, and whole needs to be multiplied by 100 in order to get the answer in percentage value. The cost of preferred stock for Basket Wonder under this circumstances is 9%. If the company is having preferred stock outstanding and has paid out $6.3 as dividend to the preferred shareholder, then the cost of this preferred share to the company is 9%. In other way around, we can say that if the company has financed $100 with the help of preferred share source, then on each $100, the company is required to pay out $9 of its cost of utilization annually. The final section of this cost of capitals is cost of equity approaches and how to calculate the cost of equity. It's a little bit complex in comparison to the calculation what we have done for debt instrument and as well as for preferred stock. Basically, we have three different mechanisms to calculate the cost of equity, which is common stock equity, and to find out what cost the company is bearing to pay out to the common shareholders. So in order to find out the cost of equity, we have basically three approaches to utilize to measure the cost of equity to the firm. Number first is to use the dividend discount model. The second approach is to use the capital asset pricing model. And last but not the least is before tax cost of debt plus risk premium approach. The emphasis to these three approaches will be discussed shortly. However, in this lecture, the prime discussion will be related with how to use the dividend discount model to find out the cost of equity. For the remaining two approaches, you have to listen to my subsequent lecture on cost of equity approaches, in which I'll explain these two mechanisms or approaches to find out or to measure the cost of equity. So let's discuss the first approach, which is named as the dividend discount model. If you remember, In the chapter number 4, in the valuation chapters, we have already discussed the dividend discount model in order to find out the value of the common share. So the same model can also be used to find out the cost of equity by rearranging the mathematical formula utilized to find out the value of the common share. So if you would like to have the more details related with valuation and the basics of dividend discount model, you can listen to my previous lecture on the topic of valuation of long-term securities. So what is a cost of equity capital? The cost of equity is usually referred with KE. K with the subscript E is the discount rate that equates the present value of all expected future dividends with the current market price of the stock. So let me explain with the help of mathematical formula. This definition is basically talking about this KE, the cost of equity, is a particular rate which we have also studied as a yield to maturity, or the IRR rate, in the valuation chapter of long-term security. So this KE is referring towards that particular percentage, let's suppose 9%, 10%, or whatever percentage it is, in which we are interested to find out. It's a rate that will equate the current market price of the stock by discounting the present value of all future dividends. The constant growth model explains that the dividend is growing forever at a particular percentage in a particular company. So D1 divided by 1 plus K raised to the power 1. Then for the second year, D2 whole divided by 1 plus KE raised to the power 2. And it will carry on up to infinity if this method is a constant growth model mechanism. So let's assume that it's a constant growth model, and in the constant growth model we know that the assumption reduces to the formula of valuation by equating the P naught is equal to, in order to find out the current market value of this common share under the constant growth model. So the basic formula reduces to P naught is equal to D1 divided by KE minus G. KE is our cost of equity minus G is our growth rate. So the previous formula, this one, P naught is equal to up to infinity, will reduce towards the P naught is equal to D1 divided by KE minus G. And how to calculate D1? It's very simpler. D1 is equal to D naught, our current dividend, into 1 plus G factor, which is a growth factor. So in order to calculate the D1, we can use this formula as mentioned. After rearranging this formula, because we are interested to find out the cost of equity under the constant growth model, so therefore we have rearranged this formula with simple mathematical rules into KE is equal to D1 divided by P naught plus G. So this is the final formula to find out the cost of equity under the constant growth model assumption by utilizing the dividend discount model. It assumes that the dividend will grow at the constant rate of G forever, because this is referring towards a constant growth model. So we are assuming that, let's suppose, at the rate of 5%, the dividend of this company will grow forever up to infinity. So under such condition and assumption, we can use this formula highlighted in yellow before you, that is KE is equal to D1 divided by P naught plus G. Here D1 is the next year dividend, P naught is the current market price of the stock, and G is the growth factor. Let's take an example to determine the cost of equity capital. Here we have an assumption and a numerical example to explain how to calculate the cost of equity under the constant growth model by utilizing the dividend discount technique. So the case elaborate that Basket Wonder is a company, has common stock outstanding, means has already sold out this common stock with a current market price of $64 per share. So P naught is $64.80, which is the current market price of this share. And the current dividend, you have to notice the narration in question very carefully. The current dividend is $3 per share. It means this is our D naught. This is not our D1. So we have to find out D naught with the help of its formula. Next, and a dividend growth rate of 8% forever. This forever means that this is a constant growth model up to infinity. So first of all, we have to find out D1, which was equal to D naught into 1 plus G, which is D naught is 3, and 1 plus G is 1 plus 8%. So this will give us the next year dividend, which is D1, which may be utilized in the relevant formula to calculate the cost of equity under the constant growth assumption. So KE was the formula to calculate the cost of equity under this case was KE is equal to D1 divided by P naught, which is our current market price, plus the growth factor. So KE is equal to D1 into this factor 1 plus GE. It will come up with 1.08. So we have to multiply 3 with this growth factor, which is 1.08, whole divided by the current market price, which is 64.80, plus the growth factor, which was 8%. So with the help of simple mathematical calculation, we come up with KE is equal to 0.05 plus this growth factor, which is 13% in our case. So let me conclude the determination of cost of equity capital, that on average, the company has paid out 13% to the owner of common stock under this case. Another way around, we can also explain that if somebody has invested $100 in this company's stock, then at the end of the first year, they will earn $13 as common stock return. Or another way, we can say that this revenue, what is considered as revenue or income for the shareholder, is actually the cost to the company. So the cost of utilizing the equity source by this company is 13% annually. Let's discuss the growth phases model as already explained. For more details, you can listen to my previous lecture on valuation of long-term securities, in which I have already explained in detail the growth phase model. However, the emphasis over here is to calculate the cost of equity, not the value of the common share. So we'll focus on the calculation of cost of equity under the assumption of growth phase model or growth phases assumption. So here we got basically 3 growth phases. Rather than to have a constant growth rate of 8%, 5% or whatever, we have different growth phases with the passage of time. What is known as, usually it's these growth phases are in the taper form. So this is the formula to calculate the cost of equity under different growth phases. Here once again, the P naught was our current market price of the share. Summation T start from 1 to A. Let's suppose if A is up to 5 years of time period, the company's stock is growing at the rate of 15%, suppose. The rest of the formula will remain as it is, whole divided by 1 plus k e raised to the power t, and then whole raised to the power t, which is 5 years. Then after 5 years, at the start of 6th year, the company's stock will grow at the rate of, let's suppose, 10%. So here the G factor will be 10%. For how many time? We have to mention over here D5 rather than DA in order to understand this, that the next phase has been started over here, and this D5 will further be multiplied by with the growth factor of 1 plus G2, which is 10% in this case. The next time period will be T minus this A factor. The previous time period stopped at time 5, so we will have to change it with 5. And then 1 plus k e raised to the power t. So it's telling us that we got first growth, which is at the rate of 15% for the 5 years. The second growth phase starts from period 6 up to period 10, let's suppose, for the next 5 years, which is 6, 7, 8, 9, and 10 year. The stock will grow at the rate of 10%. So its next second phase has been started. And further later on, from period 10 to onward, which is 11 to onward up to infinity, this stock will grow at the rate of 5%. So we can see that at the start, the company's stock was growing at 15%. Next, it was growing at the rate of 10%. And after the third phase has been started, the growth rate forever, which is a constant growth model, is 5%. And this phenomena is known as the taper off effect. So we have to minus this B, which is 10 in our case, because the T factor is 11 into T factor is T up to the infinity minus the B, which is 10. So therefore we can apply the constant growth model on this expression and can treat the first two phases as either the annuity case, or we can also use the simple mixed stream mechanism to find out the cost of equity under this case. So this is the way we can address the growth phases model to calculate the cost of equity. This was all about the discussion related with the required rate of return and cost of capital, because the company is interested in different prospective proposal to invest their precious money, and for those investment opportunity, the company will have to look at either the debt financing or preferred share financing, or finally, last but not the least, the common shares to be issued. So these are three different sources with the help of which company can finance or generate its capital. So we have to understand the cost of that capital to be borne by the company later on, and its comparison with the required rate of return, so that to use your money wisely and to earn the required rate of return in order to meet not only the company's requirement to earn profit, but as well as to fulfill the obligation of cost to be paid out to the holder of those financial instruments. Thank you very much for listening to this lecture. If you have any question, you are free to ask either on the CMS system or another way around. You can also email me with your queries on my official email address as mentioned in the footer of this lecture. Good luck for the day. Allah Hafiz.